Morning or good afternoon, everyone, depending on where you are. Welcome to Lawpath's webinar today on Business Structures Explained, choosing the right structure for tax and liability benefits. My name is Joel Comerford and I will be your host for today. Now, for those of you who are new to Lawpath, we are an Australian-based online digital legal, accounting and tax advice platform. We've been operating for 10 years and helped over 500,000 small, medium businesses in different capacities within that time frame. We are tailor-made for startups who need the service to fill in their gaps in legal and accounting knowledge, but we also work with many clients who are requesting that 6 to 12 month audit for their business, whether that's around their structure, their existing contracts, their intellectual property, or checking they are compliant with changing legislation, particularly on the employment front. We also help clients who are about to go through rounds of investing and clients who are selling or buying businesses. And of course, clients who need expert accounting and tax advice and need their taxes sorted by senior chartered accountants. We are very much a one-stop shop for all businesses in multiple different industries, and you are not too small for us, and you're not too small for ensuring you have a strong legal and accounting foundation for your business. I have the esteem and pleasure to be joined today by Timothy Quinn, or Tim, depending on how he's feeling on the day. He is a qualified chartered accountant with 17 years of professional experience in tax and business advisory at all stages of the business's life cycle, startup to exit. He has extensive experience supporting entrepreneurial clients to meet their tax obligations and advising them on making the tax system work best for them and their business. And he has run tax divisions at a director level as well. Needless to say, he is extremely qualified. If you are behind on having your tax lodgements or BAS lodgements prepared from the last financial year, or you're not happy with your current accountant, and you want Lawpath to assist you, or at least some further information on that, then Tim and his team will be the perfect option for you. And we will also have a special tax compliance offer for attendees if you stick around to the end. Now, I am conscious of the fact that majority of those attending today are accountants, so feel free to jump in and participate how best you can. We do encourage people to offer questions throughout the webinar. Naturally, Tim will do his best to answer them, and I will also do my best to respond if it's something within my capacity to do so. We will have a Q&A at the end, so please stick around for that. If any of the questions you have related to accounting or tax aren't necessarily addressed within this webinar today, you can still go ahead and answer them. Ask them, and Tim will do his best to respond. I should also be clear as well for anyone who's new here. This is an opportunity for you to get essentially free advice and guidance on what's going on in relation to what Tim is addressing in the webinar today. But this is also an opportunity for us at Lawpath to offer our services and our resources. So naturally, before the Q&A, I will be offering a little 2-minute sales pitch. I do hope that isn't too stressful for everyone. If you do have a time frame that you have to keep, we do try to keep this within 12 to 1. Obviously, if you're in WA, it might be 11 to 12. So if anyone is interested in any of the resources that we provide, or if you do like the guidance that Tim is offering today, this is essentially what you'd be getting on our accounting or tax plans. So I will ask at the end if anyone is interested in having a further conversation. End of financial year is coming up. We have some great offers, and also all of our plans are 100% tax deductible. So keep that in mind. Also, there will be the PDF slides sent to everyone from today in an email at the end, and this webinar will be recorded and uploaded to our Lawpath YouTube page. Perfect. Tim, take it away, sir.
Thanks very much, Joel. And I am feeling friendly today, so Tim is just fine. We can drop the formalities. Welcome to everyone, especially old friends. I certainly see some familiar names on the attendees list. Lots of accountants too. I won't judge you. I'm an accountant. We all need a bit of mutual support occasionally. So it's great to have a few of you here today. And for those of you who, of course, run their small businesses or are thinking about setting up a small business, you're thinking about your structure first. Good on you. A lot of people don't think about it until it's far down the line. What I would say is that if you're already up and running and you've got a business and you think that as a result of this presentation that you've got the wrong structure, don't fret. It is really quite straightforward in Australia for a small business to restructure. We can take you from one model that you've got into another model. There's often lots of nice small business tax concessions to get you there without too much drama. So what are we going to cover off today? We're going to have a look at the basics of a few different business structures and why they might work for you and how they're taxed. Sole trader, partnership companies. We'll focus on sole traders and companies. Partnerships are a bit old hat. A lot of people don't like them these days. Still got a purpose, but most of you will be weighing up between a sole trader and a company, potentially using a trust as well. Maybe not a trust on its own, but as part of your structure. So we'll look at what these structures mean, what the difference is, what the types are, how they're taxed, and how they are regulated. And then, as Joel said, he'll give you the sales pitch at the end. It's nice and painless, I promise. Let's jump straight in. What are the most common business structures? The easiest of them all is the sole trader. That's you. That's all it is. All you need is your human legal person and an ABN. So an Australian business number. It's nice and easy to get. I think we register about 1 in 10 ABNs in Australia here at Lawpath, so it's bread and butter. An ABN is basically a way of demonstrating that you are a business, even though you are a person. Timothy Quinn can have an ABN as well as having a legal name. Getting a bit more complicated, maybe I want to go into partnership. Maybe I think that I've got someone that I love and trust, and I think that we can go into business together. And the two of us will sign up a partnership. As we get increasingly more complicated, maybe I'm thinking about incorporating. Maybe I've heard all these things about asset protections and the risks of being sued, and I don't want to lose my house. So maybe I'm thinking about a corporate structure. One step beyond, I've heard about these trusts, probably from listening to any of my webinars where I try and talk about trusts as much as possible because I love them. We can go into that in more detail, but this is really the best time to start looking at these structures. What makes them different? What makes them tick? So like I said, it's as simple as being a human being. It's very simple to start a sole trader business. Simplicity often comes without potentially the complexity of setting up that is a barrier to setting up. We want small businesses to get out there and start going. We want them to start working. It's an easy way to do that. You're not paying big fees up front. You can basically get going tomorrow if you wanted. They're very, very cost effective and easy to do. And of course, it's you. You can make whatever decision you want. It is your business. You do it the way you want to do it. The profit's yours. The assets are yours. You don't have to do this arm's length dealing. If you're working with yourself as a business, it's all yours. You can do whatever you want. And there are fewer regulations. But of course, there are disadvantages too. They're too scary to even put on a slide. When we say control, we also mean liability. So if you have a sole trader business and you're out there doing something that potentially your customers don't eventually like, what's a nice polite way of saying this? You might be attracting litigation. So you might have customers out there or suppliers or anyone that comes after your business, rightfully or wrongfully. It's no judgment of mine. It's ultimately the judgment of the courts to decide whether you're right or wrong. Either way, you're going to pay money hand over fist. But that is the nature of a sole trader business, is that anyone can sue you for everything you've got. So if your sole trader business has reneged on its requirements to pay or whatever it is, or hasn't delivered, and you say, well, that was my sole trader business, that wasn't me, too bad. The courts will look straight through that and can come after any of your assets. So that's obviously a bit of a trade-off to that simplicity. That's why we try and look into more complicated structures sometimes. A partnership. I did hint that it's a bit old hat. There are still partnerships out there, but a lot of businesses that you would think of as being partnerships aren't anymore. Particularly, Joel mentioned a lot of accountants in the room. We think of accounting firms as partnerships. We still call principals partners. A lot of those structures are not actually technically partnerships anymore. I'll go into why that is. Partnerships are still reasonably straightforward. It's two or more people going into business together, shared aims, shared objectives. You share your profits or your losses. Partnership is not a legal entity, although you can incorporate in some states and territories. It is really just a relationship between the parties, the two or more parties, and it's subject to a partnership agreement that lays out these are the expectations, these are how we share the profits, these are how we share the risks. Typically, the assets are co-owned by the partners or potentially owned still by the individuals and leased out to the others. Now, here is the scary reason. Here is what people do not like about partnerships is joint and several legal liability. What that means is that if you've got two of your mates go out hell for leather into a great new business idea, and one of them's a bit of a loose unit, does some crazy things, makes people upset, and the partnership gets into trouble, it doesn't matter that your dodgy mate has nothing and that you've got all the assets. Because of joint and several liability, you as the innocent partner in a ultimately dodgy partnership can be pursued. So that's the real number one reason why partnerships aren't as popular or common these days. Also, it's difficult to raise capital, nigh on impossible to raise capital within that structure. Of course, you can get money in other ways, but it's more complicated. So that's the real disadvantages. Now, the advantages there are true and obvious, is that you gain from the group. You get the group's level of expertise and resources. You get to have a brains trust of people that you can consult, and everyone just deals with their own tax their own way. So if one partner has a way of dealing with taxes that's different to yours, go for it. It's really neutral from that respect. But what you can see is that a lot of those advantages for partnership can be achieved other ways. Often we would consider a unit trust structure or something like that. So don't rule it out, but just know that they're not as common as they used to be. You do still see them in some sort of joint ventures and property development sometimes. Companies, this is where we probably will focus more of our time talking about companies. Companies are very common as well. Plenty of companies set up every day. I see the business services team at Lawpath. It's like their laptops are on fire. The level of activity we have in company registrations here is huge. It's a great company to set up companies in. It's really, really straightforward. What is a company? A company is its own legal entity. A legal person is often how it's referred to. It is incorporated with ASIC, so our corporate regulator maintains the list and details of all of these companies. That separate legal personhood means that it has its own rights and obligations under the law separate to its shareholders and officers. So that means that it can hold assets, it can bear risk and liability, it can sue and be sued. Now, we'll talk about the difference between types of company a bit later about how liability is limited. But the essence of that structure is that you are creating an entity that does not live or die with you as a person, as an individual. You're creating a structure that has its own obligations under the law. That can mean that as long as, this is going to be a big caveat, as long as you're doing your duties as a director to that company and subject to a few other carve-outs, the risk of that company going down and going bad does not have to sit with you personally. But we'll get into that in a little bit more detail. What are some of these pros and cons? We've probably mentioned a few of them already. The limit of your liability to most private companies, if you bought a company, set up a company for $1 and one share, that's the limit of your liability. So if anything goes wrong, if there are debts beyond that, again, subject to various carve-outs, then you are not liable personally for those debts. We've mentioned a few on that list. If you care to read the slide, a few of the exemptions to that, you obviously have obligations not to trade while insolvent, and you have particular obligations in relation to payroll liabilities. So tax on payroll and super, things like that, that can still attach to you personally. So do just bear that in mind. And basically the cons of that We've only talked about the pros of a company so far. It is a little bit more complicated because it's its own legal entity. It has its own tax return. Sole trader doesn't have that. Sole trader is just your own personal tax return. Once you've got a company up and running, you have to pay ASIC once a year. You have to pay your company tax accountant once a year. Although, of course, that is not a particularly onerous obligation if you're with Lawpath. We offer very, very uh, cheap and valuable tax returns, services, tax plans that Joel can talk about. There are a con, if you think of this as a con, in terms of making yourself as a director aware of your liabilities and sticking to them. When I say liabilities, of your obligations. As a director of an Australian company, you do have particular obligations that you have to meet. There are things like your shareholders' meetings, there are filing requirements, but there are also general duties that will attach to you in how you carry out your activities on behalf of that company. Look, we say here as well that there's complicated tax treatment. I don't think it's overly complicated. Once you've set up and run your first company, you'll see it can be straightforward as long as you hire the right advice. Now, I'm just very conscious that I'm rattling through some of these early slides. Please do feel free to lob in questions in the chat. I'm very happy to pause as we go and field your questions. They can even be difficult ones. They can be easy ones too. I won't judge you either way. All right, so here's just a bit more about the idea of the company structures. You don't have to be as simple as just one company held by one person. You might get a bit more complicated. I don't like over complexity. I like just enough complexity to achieve your commercial objectives with a little bit of tax savings, if we can squeeze that out as well. For a lot of clients, that will mean things like a dual company structure. So that will mean a holding company at the top that does nothing except own a company underneath, which is what we call the opco, or the operating company. So it's the operating company where all the stuff happens, all of the trading. Often the employees will be held there, or perhaps even in another operating company to hold employees. The holding company, all it does is sits pretty at the top of the pile and potentially attracts investment, potentially it owns resources. And what we've managed to achieve with that sort of structure is that we've kept the risky bit is your operations at the operating company. Anytime you're doing anything, you're hiring people, you're buying supplies, you're making something, at that operating company, there's risk. And we've managed to keep the assets separate to that risk. So we've kept the assets at the holding company level, the risks or the liabilities at the operating company. If the operating company is attacked in the courts for a breach of a particular obligation, it is much more difficult to hit the assets that are all held by the holding company. So you can almost cut off that damage and create a new one in its course. So that's really why we love a dual company structure. It's also much easier to attract investment into a holding company rather than having a structure of 8 companies that do 8 different things. And every time you raise shares, you're updating 8 corporate registers. It's an absolute pain in the backside. So holding company is a really nice way of attracting investment. Now, that's not where it ends. Anyone that's done these webinars with me before, and I've already hinted at it, I love a good trust. In particular, I love this golden structure. So I always call it of the operating company, the holding company, and a family trust on top. Now, why do we have that family trust on top? There's, I guess, a further distancing of yourself and your personal assets and your personal wealth from the operational risk. So it's great from an asset protection perspective. But in particular, there's an additional benefit. And we'll talk about trusts a little bit later. But that is the idea that when the profits come up through this lovely structure that we've got, if it goes out that the profits come to a shareholder, the tax is as it is. You play it as it lies and you pay the tax on those profits. If you have a family trust sitting on top of that pile, that trust has discretion. It's able to look at different family members and once a year sit down and say, this is how we're going to distribute profits. We're going to do it in a way that makes sense. We're going to do it to those in our family group with a lower tax rate. So it's a really powerful structure. And I did see that we're about to have a question posted in the webinar, so I'm happy just to pause for a second if that's incoming. And I think we might have both the chat and the Q&A. So while here we go, we've got a couple of questions coming in. Marina has asked, what are the journal entries when buying a business into a new specially set up trust? I think the exact journal entries are probably a bit beyond what I can cover in this. But yes, you get accounting advice to look at what is the business that you're actually buying. So as a new company structure, you would look at what is the business. Typically, you do a process where you'd look at assets coming on, physical, tangible assets. So that might be debit, motor vehicle, whatever it is. Depending on how much you're paying for that business, there might be what's called residual goodwill. So if you're paying $1 million for a business that ostensibly on the balance sheet looks like $500,000, you might be acquiring some goodwill as well. So a bit of a complex one, Marina, but definitely worth talking about with your accountant because it depends on the type of business that you're purchasing. Richard's asked a couple of questions. Do charities need a holding company structure? No, not typically. And we'll talk about different company structures a little bit later. A lot of charities are companies limited or public companies limited by guarantee. So typically they don't have shareholders. That's very, very common for charities. So you don't really need a holding company because again, your liability is being managed elsewhere. So with a different structure, your liability is still limited, pardon me. So yeah, typically not, Richard. You do see some funny ones. You do see some not-for-profit entities with shareholders that are set up as private companies, but they're uncommon. Typically, they are limited by guaranteed public companies or they are state-level incorporated associations. Shirley's just quickly asked, what are the benefits for a family trust to holding the entity? Why would you have an interposed holding entity? Again, just more flexibility and again, a further degree of separation, and any separation of risk is good. So having an extra holding company in between. You might also look to gain additional investments. So your family trust might be only one shareholder in the holding company eventually. You might look to bring others on board, in which case having that holding company is still worthwhile. And just the last question to deal with now, is it safe to open a family trust as an operating business with a company as trustee? You can do what's called a trading trust and having a trust actually doing the business. I would certainly recommend having a corporate trustee, as you've mentioned, rather than an individual trustee. I like, and I don't know if I have a reason for this, it just feels cleaner. I like to have businesses operating in a company and have that company held by a trust. I think it's almost one of those things that when you look into a contract or even down the bottom of a web page, when it says so-and-so family trust trading as Joe Blogs Motors, it doesn't fill me with the same level of confidence as seeing an operating company. I don't know why that is, but maybe that's just my preference. But these are great questions, guys. Do please keep coming them in, and we'll progress with the slides as well. Company registration process in Australia. As I mentioned, registering a company in Australia is not the most difficult, arduous thing to do. There are, of course, tricks, and that's why you should do it with a professional rather than yourself. But it doesn't have to take too long. It doesn't have to be overly complicated. We've got two major company types in Australia, the public company, which you can tell by the word limited at the end, and a private company, which is typically will have PTY limited or proprietary limited. Public companies, these are typically your larger companies. So over 50 shareholders, you must be a public company. If you are looking to attract investment from non-related parties, if you're out there offering shares in the marketplace, whether that's on the stock exchange or any other form of offering capital out to the public, it must be a public company. Public companies have particular rules, must have 3 directors, must lodge particular sets of financial documents with ASIC. It's a rather larger endeavour. Most companies, the vast majority of companies in Australia are private companies. These require 1 director that is an Australian resident. We'll go into that in a bit more detail, but it's really a much smaller endeavour. The ASIC, the corporate regulator, as long as you're doing your annual little bit of paper where you say no changes or you update your address, that's typically all ASIC cares about. They don't usually want to see your financial statements until you tick some rather large thresholds of activity. Now, once you've determined which of those company types you want, we go into looking at a governance structure. I will be honest, most people just do the tick box exercise, which is that ASIC, or the Corporations Act, which governs companies in Australia, has what are called replaceable rules. So if you just set up a company and go hell for leather, there are structures in place that you import and that become part of your governance structure. I would say that's what most companies do. But of course, one size does not always fit all. And so therefore, we certainly recommend, as we'll talk about later, having proper shareholders agreements and choosing company constitutions. Of course, if you want to have directors or a secretary for these companies, you've got to get their consent. You can't force someone to be a director of your company, alas. This is typically the thing people do first, is you've got to choose a company name. It has to already be open. It's the most disappointing thing to tell people, particularly young people starting startups, when they go down the path of the pitch deck, the slides and all of these great ideas and logos, and you have to tell them, unfortunately, that name has been taken. So you can do a quick search on ASIC to see what names are available. And of course, it has to be unique and has to represent your business. There are some restrictions on company names in Australia. No swear words, please. No reserved phrases like university, Anzac, things like that. As you'd imagine, there are particular words you can't use, but you can always search. Got to have a registered company address. For a lot of our clients, that might be Lawpath, and we can offer services there to be your virtual office in order to do that, or it can just be your home address, of course. Very, very simple checklist. Are you ready to go with your company registration? If you've got a name, do you want to be public or private? You probably want to be private. Do you understand your obligations? Let's go for it. Time to get registered. Just one quick question has popped up. If you operate a company under a company structure, operate a business, you need to pay company tax. On the other hand, if you run a business under a trust, you do not pay any tax. Why do I prefer a company rather than a trust? Well, I agree with you that running a business directly through a trust, the trust itself doesn't pay any tax. But of course, the beneficiaries of that trust will pay tax. So it's not like you're avoiding the tax entirely. The company in that structure will pay tax, usually at 25%, of course, for a small business. That tax is not lost. So you get what's called a franking credit for that 25%. And when you eventually farm out the profits through the family trust to the appropriate beneficiary, they get the benefit of that tax already paid. So you can actually, I would say it's almost neutral from a tax perspective there. But that's a great question. Oh, and Shirley's already answered it for me. The benefit, I think, of having so many accountants on the call. We've got so many co-panelists today. Thank you very much, Shirley. Yes, exactly right. Let's keep going. Just have a think about some additional things on your list to do with your company. Your additional compliance, you've got to have what's called a DIN. This was an absolute pain to apply for a few years back when these rules came in. The Australian government does want to know who you are, so you need to get a particular ID. The first time you do it as a company director, it's painful, but then it's yours. So you'll have a unique director's identification. You, of course, need to be aware of the fact that a puppy is for life, not just for Christmas. And when you do set up a company, you are subjecting yourself to rules and obligations. You do have to pay the ongoing fees. You do, if you want to stop running your company, you have to wind it up the right way. You can't just leave it and it will not take care of itself. It must be wound up the right way, and that there are costs of doing so. So just make yourself aware of that. And of course, your director's responsibility and the fact that you can lift the corporate veil, or pierce it, as they sometimes call it. And you can sometimes get personal liability from a company. We'll talk about that a little bit later. Do be aware of that. Marina's just made a comment. I'll take that as a comment that you prefer trust because you don't have to wait for the company to do a tax return to get franking credits. True, although typically in a well set up structure with a trust and holding companies, you would take drawings in anticipation of dividends, so it doesn't need to be a delay. But yes, I take your point there. It is simpler. So thank you for the commentary there. How do we tax these entities? So we've touched on that in the comments a little bit already, but let's go into it in some more detail. The sole trader is its profits. So we don't tax income in Australia. Most countries are the same. You have your income minus your expenses is your profit. That profit gets added to your sole trade. It gets added to your personal income as a sole trader. So if you've got what we might call a side hustle or a small part-time business while you're also an employee, you might have $60,000 of employment income. You might additionally have a $30,000 profit from your side business. Nice and straightforward. Your taxable income is $90,000. So you just add it onto your personal tax return. Very, very straightforward. No additional lodgements required. Now, what about losses? What about if your sole trader business makes a loss? Can be a little bit tricky. You can get stuck in a bit of a hole here. Unlike other bits of income, which you can easily offset against each other, if you have losses in a small business, you might not be able to offset that against your personal income. So there are ways of doing it. There are 4 potential tests to do, what are called the non-commercial loss rules. That will mean if you meet one of these tests, you can use losses from your business to reduce your other income, but just don't take it as a given. It's certainly something that you should talk to an accountant about. Companies, we've touched on this already from the comments, which is that profits are taxed at 25% or 30%. To be quite honest, the threshold is enormous. Anyone on this webinar today, I dare say you'll be paying tax at 25%, what's called a base rate entity. This gradually came down from 30% over the years and is now set. Now, losses are trapped within a company, which sounds alarming, and it can be. But the reality is, if your company has made a $100,000 loss, absolutely it's useful into the future to offset your company's taxable profits. However, you cannot just say, well, I'm going to wind this company up and leave it. I would like those losses to reduce my personal income. Unfortunately not. The losses are trapped. Partnerships, a little bit more like sole traders. I guess to the extent allowed in the partnership agreement, the profits are shared between the individuals. And again, it just gets added to your marginal tax. So it adds to the rest of your income. The losses, again, there's a few requirements here, but it's a little bit straightforward. There's similar sort of non-commercial loss rules. You can offset partnership losses against your personal income. So it's not trapped like it is in a company most of the time. Trusts, we haven't really talked about trusts except for use with a company, but the point remains true. The trusts themselves are not taxed unless you've done something wrong, in which case you're going to be paying some very oppressive marginal tax rates. As long as you've distributed profits, whether you're a discretionary or a unit trust, then those profits will be taxed at the beneficiary level. So at the person that actually receives the trust distribution, they will pay the tax. The losses are trapped within the trust. It's always the first year accountant dilemma of when you're a graduate accountant, you try and distribute losses to beneficiaries and you scratch your head wondering why it won't work. It doesn't work by design. You cannot distribute losses through a trust. Just before we move on, just some great commentary from Marina saying she loves the webinar. I'll take that any day of the week. And just a question saying, can you choose to pay dividends to directors anytime? Yeah, you can. It's unusual. You typically see companies only declaring a dividend, private companies, often just once a year. Public companies, particularly those listed, maybe twice a year, December and June. But you can declare at any time. What you typically see is directors will take what we call drawings, is that they'll take money as needed from the business. And then when it comes to year end, when you're looking around the 30th of June, you might pay back some of it, you might declare some of it as a dividend, you might do a bit of a cleanup. So I wouldn't say you typically go through the formal process of declaring a dividend every time you want to take money out as a shareholder. But that is certainly one way of doing it. Marina said, if a trust pays the 47%, yeah, that oppressive tax rate, would it be claimable like franking credits? Do you know what? I don't think it is. And I can safely say I've never actually seen it in 18 years of practice. I've never come across an accounting practice that is so incompetent as to not have distributed income correctly to beneficiaries. So I'll take that one on notice, Marina. I'll do a bit of reading. We've talked about this at length. I'll probably just very quickly cover it off. The whole idea of these structures is often to avoid personal asset exposure or risk. The sole trader is the risks are yours. So the risks are real and they lie on you. The partnership, even worse, the risks that you take and the risks that your partner are all yours potentially. Companies and trusts are where we are able to limit some liability. Trusts with a corporate trustee, and companies obviously are their own legal entity. They have their own legal personhood and subject to particularly, unless there's very egregious behavior or very incompetent behavior in terms of your duties, then you can typically limit to potentially nothing your exposure to risk. Jump straight ahead. What structure should I choose? There's no right answer. It's different for everyone. That is why I do recommend you come on board with someone like Lawpath or the accountant of your choosing. I don't want to offend any other accountants in the room. Whoever you trust, go to a trusted professional who's experienced, who's done this before, who has seen the highs and the lows. So from all the years of experience, I've seen some pretty bad structures. I've seen more often some really complicated structures that didn't need to be that complicated. Don't be afraid to ask questions. If you've inherited from an old accountant a particularly difficult structure and there's 15 trusts involved and 23 companies and no one can tell you why, it might be time to simplify it. If all you're trying to do is obfuscate and make it, hide little bits under the rug, it's probably not going to affect that very successfully. And you're probably paying an absolute fortune in compliance fees. So it is highly individual. I would never recommend sight unseen a particular structure to a particular person. What I do look at is risk, tax implications, and cost. Those three things, they do weigh up differently for everyone, but they are the three essential things that you will weigh up. So just have a chat to someone. Lawyer will be able to help you out, but probably an experienced accountant is probably just as good. And Arshad has said, yes, directors are liable if they provide personal guarantees. Subject to that personal guarantee, yes. So if you have signed off on a loan through a company and you've been a personal guarantor to that loan, absolutely you can be personally pursued for that loan. That's a really good point of clarification. And Alberto, hello, good to see you again. What's the ideal structure for a startup sole trader? Well, if you're just dipping your toes into business, a sole trader ABN is fine. Although once you probably start to take more risks in your business, if you have larger suppliers, if you start to have debts on board, then incorporation is a great option for you. Yeah, look, a comment here is that the DPN or the director penalty notice has made a company more like a sole trader. I would say yes, to an extent. Companies are becoming easier to pierce for particular obligations. In particular, those red letters from the ATO, the director penalty notices, if you haven't paid things like superannuation or PAYG on your BAS on time. Yes, it's more like being a sole trader. I would caution there is still a whole heap of liability that is effectively ring-fenced by being a company. And of course, in a company structure, there are ways of getting around those DPN notices. There are ways of restructuring and of structuring debt and of liquidating and small business restructuring, things like that. So I don't think the company's dead yet. I think the company structure is here to stay. And wouldn't you know, I think I might have gone through, I was going to say, I can't have gone through all the slides already. There's just a couple of little salesy slides. I'll let Joel cover them up at the end. All right. What are we considering? If I'm being asked on the chat, which should I choose? All right, let's go through the questions. When you're setting up a company, do you have an Australian resident director? Australian resident does not mean citizen. It doesn't mean permanent resident. It means resident for tax purposes. If you are here and you're here all the time, you are an Australian tax resident. It's pretty hard to avoid. There are edge cases. You're here for 162 and a half days out of the year. Can get more complicated, but it's a pretty straightforward requirement. All Australian companies must have an Australian resident director. Now, you might think, how is that possible? There's plenty of foreign companies that operate in Australia. Yes, and they will all have an Australian resident director. If you were to search me up on ASIC, you'll see I've been a director of about 60 different companies in my life. That is because I have been an Australian resident director for foreign-owned companies. You do have a lot of responsibilities. It's not something that you just sign away with your life. You do have to take your responsibilities carefully. If you are considering being a director, you should educate yourself. You should talk to your professionals. What risks am I taking on? If your professional says you are taking on no risk as a director of a company, they are lying to you, and you should run for the hills and talk to someone that will give you the straight talk. There are risks to being a director, but you can manage them. Who are going to be your shareholders? This is not a silly question. You might think, of course, it's going to be me, or perhaps it's your partner as well. Perhaps if you're in you would almost consider the traditional, the old school family structure where one partner works more than the other and gains more income. Potentially, you want to split those incomes if you don't have a trust and you can't do it effectively. You might think about a 50-50 shareholding. It might reflect the actual input into your family business. It might be 50-50. Maybe you want that shareholder to be a family trust because you don't want to decide now. Good option. Think about your other things, your legal protections. Go out there, get your trademark protections for your business names. Make sure you haven't just done the set and forget. You haven't done the easy option on the constitution. If you've got unrelated people or related people for that matter, running a company, are those expectations and plans put in a shareholders agreement? Shareholders agreement we'll touch on a little bit later. Very, very important to consider not how things go when they're going well, particularly. It's typically they come into play when things are not going well, when there's disagreement. It's really, really important to protect yourself with a shareholders agreement. And our lawyers here write exceptional shareholders agreement, if I may say. Another question, when you've got people working in your business, how are you going to pay them? Now, on our accounting advice plan here at Lawpath, I'm privy to hundreds of conversations that our customers have with our accounting advisors every week. This question comes up more than most. How do I pay people? Are you going to put them on payroll? Are they going to be employees? Are you going to be an employee? Are you going to have contractors or directors' fees instead? How are you going to make some money? How are you going to personally draw some money out of this company? Have the discussions now. Have a think about it. Don't leave it too late. I'll just take a pause to go through some questions. Here we go. So we've had some questions there about, is someone from Lawpath able to assist in yeah, absolutely. We'll reach out to you in relation to family trust with trustee matters, going through family matters. We can help you with that as well. Another question has come up that says, who owns the shares in a corporate trustee? Typically, the shares in a corporate trustee are held by the directors, the two individual people. Can a corporate trustee also be a bucket company? I recommend strongly against it. I don't believe that there is a legal impediment for doing it, but there are smart reasons from smarter people than myself to say that you should not have a corporate trustee also being a bucket company. There are rules about when you're a trustee of a trust, who do you owe a duty to? And it can get a bit complicated if you're a potential beneficiary as well. So I would caution against it. And that's certainly common practice as well. There's a question of clarification. Is someone on a student visa, are they considered a resident for tax purposes? Can they be a director of a company? It's a very good question. I'm not certain of the answer. I'm going to mark your name and I'll get back to you. There
Tim,
are,
if
sorry.
if I may, in my experience, usually if someone's on a working or a student visa, one of the best things you can do to begin with is just check the details within your visa itself. Different countries vary, but it should be able to denote whether or not you do have the ability to do that within Australia. But also, further research is also advised.
Because there are particular visas, temporary visas or student visas that make you a temporary tax resident rather than permanent or rather than an Australian tax resident. We've had a question, how best to choose company and trust names? Your imagination. The more imaginative you are, the more likely your company name is, or the less likely it is that that company name has already been taken. So you can really choose whatever you feel. Can a child be a beneficiary? Yes, they can, but for tax purposes, we advise that they aren't. This used to be a great way of plugging $100,000 of profits to your 2-year-old and go for gold. There are rules now about under 18s that say you can only distribute them, from off the top of my head, $416, something like that, before they start to get taxed at very high rates. So a good idea, but wait until they turn 18. Mark has asked, if you incorporate with a sole director, do you need to pay yourself wages? Can you draw director's fees? This is going to upset you, Mark, if you're hoping for an easy answer. You can't just draw indefinitely and pay yourself because the ATO quite fairly says, look, this company is a company with its own legal personhood. If you are paying yourself and just taking the money, you've got a couple of options. You can put yourself on payroll. You can do what are directors' fees as well, but there is an argument that the company has withholding obligations on those directors' fees. Certainly, if the company doesn't, you will regardless. So what you'll typically do with drawings is that your accountant will look at it at year end and say, well, can we classify some of these as after-tax dividends? Is there still the potential to declare them as directors' fees and where the liability at the individual level? There is no one straightforward answer that works for everyone. You certainly can take money out of your business throughout the year and it can be cleaned up from a tax perspective. Don't think that you have to wait until the year-end dividend. And just one final question before we move on. How to decide ownership percentage? It's up to you. It's a commercial thing. It depends on your circumstances, depends on your agreements with fellow shareholders or with your family members. There's no one right answer there. Just a few other things just to consider. Does your industry require particular permits or licenses? Most don't. You'd be surprised. It seems like in the United States, if you want to scratch yourself, you need a license for it. In Australia, most companies you can just get up and run. But of course, things involving liquor, gaming, property development, and industries where, as you'd imagine, education, health, things like that, you will require additional licensing. And you should do your research on that as well. Get your insurance in place. For a small business, public indemnity and professional indemnity insurance is reasonably cheap. It's still going to be a bill shock when you get it, but it's worthwhile having, and just consider some additional insurances as well. I say optional. If you've got employees, you must have workers' compensation as well. Just one last question. If you have R&D grants, do you need to pay that back before you take money out? In Australia, I assume you mean R&D tax incentives, which is actually a tax offset. That does not need to be repaid to the government. That money is yours to spend as you will. If you have a particular grant from a different industry, you would have to check the terms of the grant agreement. But in terms of the R&D tax incentive, the big one out there, Daryl, no, you do not have to pay that back. Shareholders agreement, I briefly, and I do know we've still got a few things to get through. You should talk to a lawyer. That's all I'm going to say on this. A shareholders agreement is going to determine, like I said, not just how you interact when things are good, when the company's making a fortune and everyone's getting paid. It considers what happens when your co-founder that you've given 50% of the business to suddenly stops responding to emails or can't be bothered anymore, or is taking steps that are hostile to you and to the rest of the business. This is how we deal with how to get people like that out and what are their rights and obligations on doing that. When I talk about preemptive shares there, can they just go and sell the shares, their 50% share in the business to someone you don't know or you don't like? You would, of course, have what are called preemptive rights in there to say, well, if you're going to sell your shares, I get first refusal at buying them if I want. There are things like drag along and tag along rights that talk about how a minority and majority shareholders treated when a buyer comes in, who gets the right to give it the tick or to say no. And the very, very important one, the dispute resolution provision. If it starts to cause a ruckus, can I just go straight to, or can my co-partner go straight to the courts and start an action, or are they obliged to follow dispute resolution procedures, which are much cheaper first? Very, very common cause to put in an SHA. Director's duties, again, I'll put on my bush lawyer hat as someone that doesn't practice as a lawyer, but spent a very enjoyable few years doing a law degree. You must act in good faith and for a proper purpose, which basically means you are making yourself aware of your responsibilities, you're following them sincerity, and you are acting in the best interest of the company, not of yourself. You act with care and diligence. Like I mentioned, you can't just turn your mind away from your obligations and say, oh, I didn't know. When you're acting with reasonable care, it's your job to know. So you must educate yourself about your responsibilities. You must turn your mind to executing those responsibilities. You can't just say, oh, I thought someone else had it covered. You can't do that. Insolvent trading, that's a big one. For those of you who said, what's the point of having a company? Because it all just comes down to you. If you're negligently letting your company become insolvent, if you know you can't pay your debts and you're taking on more, that is insolvent trading, and that will give you personal, very negative implications. So you must prevent insolvent trading. Now, what does that mean practically? It means if you think or suspect that your company is already insolvent and can't pay its debts when they come due, it is your obligation to either get out of that situation by raising money or to wind the company up before it gets any worse. Improper use of your position. You can't use your position as a company director for your own personal causes to give yourself an in into something else that is not in the interest of the company. Information that you come across, it's not yours. If you've been exposed to personal information or confidential information, you must only use it for a proper purpose. And I think we've touched on this as well. You must prevent conflicts of interest, but also be aware of potential conflicts of interest and mitigate and disclose those conflicts of interest. Yes, nice and straightforward. Joel, I will hand it back to you. You can talk about how Lawpath can help us out.
Thank you so much, Tim. How is everyone doing at the moment? Can I get some yeses in the chat if everyone's enjoying this webinar so far? Keep in mind as well, if you do have any accounting or tax related questions that aren't necessarily part of today's topic, feel free to still address those with Tim. I know we are a bit strapped for time, but we'll try to get through them. I'm just looking at the polls here just to get a better insight onto the needs and I guess the way in which everyone's operating at the moment. Good news for some of you if you're a newer business and you're looking to hopping on an accounting software. We are currently a partner with MyOb, but we are now a partner with Xero as well. So the offers we have, which is available for everyone on their freemium Lawpath account, Xero, you get 90% off for the first 6 months. And the same with MyOb, get started with a 30-day free trial plus 50% off for the first 11 months. Really cool stuff there. And then also we have, do you have specific tax considerations or concerns? A lot around GST, tax deductions, and tax compliance. So if anyone is obviously interested in learning a little bit more about how Lawpath can help in regards to your tax and your BAS, now's a great time to do it. All of our plans are extremely tax deductible, and next month it's going to be, I'd say I'm probably going to wake up tomorrow and it's going to be end of financial year anyway. So it's a good time to get in and spend a bit of money for your business before then. Really solid investments. And there are a few people who are interested in getting some legal guidance as well. Again, guys, all of our plans are pretty much designed for start to end of any business. So if you are looking for some support through legal advice, please let me know at the end and we can go ahead and sort that out for you. Now, in regards to our plans, the main two plans we'll touch on here is the accounting plans because this is a accounting related webinar. The first plan is our just general accounting advice plan. If you are a new business and you are setting up through Xero or Myo, but you don't really know where to start, our accounting advice plan will assist you in helping you first set up the account, and we will walk you through it, and then we will get you started with your invoicing and your payroll and all that other information. If you feel self-sufficient and you want to just go ahead and do your own bookkeeping, at least for the first 1 to 3 years, then certainly this is a good option for you. You can hop on a call with the accountant whenever you want uh, throughout the year, throughout the 12-month period you're with us on the plan. And you don't have to pay each time you speak to them. It's a single payment and then you're on. For a more cost-effective approach, we do have a quarterly option here as well, 537 per quarter, or you can pay 1668 for an annual if you just want to get it knocked out of the way and not have to worry about bills coming every 3 months if it's the first year of the business and you are dipping in and out of having clients or not. Then we move over to the tax plan. This is Tim's team's domain. If you're happy to just have someone do your tax and BAS for you, then this is a perfect opportunity. You will have people at the equal caliber of Tim taking care of all your taxes. As you can see here, financial statements, BAS, and one thing that Tim mentioned to me a while ago, which is really nice as well, is I do believe we offer personal tax returns for $100 as well if you are on that plan. Now, if you are interested in getting legal, accounting, and tax in one big hit, if you wanted to build those strong pillars for the first year, we do have our bundle and save. So as you can see here, you can get legal, accounting, and tax all in one hit, and this will basically cover you for all compliance you realistically ever need. And then moving forward, we don't really have any ridiculous cancellation fees or anything. You can hop on us for the first year, help us educate you on creating documents, revising documents, future business movements, taking on employees for the first time, all that jazz. Accounting, again, investing in things. Where do you put your money? How do I reduce the amount of taxes I'm paying? And then obviously the tax plan is very self-explanatory. So if this is of something of interest for you, I will go ahead and get some names at the end and we can go through and see if we can assist you. Now, if I do call you afterwards, if you do put your hand up, keep in mind at Lawpath, we're not going to try to jam any sales down your throat. It's more of just qualifying you to make sure that you are getting the right thing. If we can determine that you won't necessarily need legal or tax, but maybe just accounting, then that's fine. We have different options. So you can get legal tax, accounting and tax, legal accounting, for example. Whatever we can determine collectively would be best for your business is what we will offer. But at the end of the day, it's up to you guys to decide what you think would be best for your business. We're just here to help in any capacity that we can. I should also mention as well, if you came late, the PDF will be available for everyone. The slideshow presentation will be available in an email I'm going to send out, and you can find this entire episode on our Lawpath YouTube channel. We usually do like to upload them maybe a couple hours after the webinar, but some days it's very busy, so we might have to push it to the following day. And as you can see here, there is a wonderful discounted offer for the tax plan at the moment, 30% off. And yeah, that should be pretty much everything for me. Tim, was there anything I left out that you think would be good to mention as other than end of financial years coming up, and we
Yeah.
can assist people in claiming all this back?
I would just mention that, look, if you do get on board an annual plan, that annual payment is immediately tax deductible. So if you're looking to cut your taxable profits in 2025, prepaying expenses is a very nice and straightforward one to do. So even though it's covering mostly into next financial year, you can get the deduction for it now.